How can I do better in pre or post-retirement in the next 3 to 5 years? Well, if you don't own these 7 companies' stock individually, then fire your advisor. And here's why. Here are the stocks that will hold their own through this tough economic environment. And if you haven't held these positions individually, then you need to fire your advisor now. Dave Dooley here, a 40-year veteran of the financial markets and fiduciary. You want to stay tuned for all 7 picks. Let's take a close look at these mega companies and why holding them long-term has and will pay huge returns in the long run. Let's dive in with Apple. Year-to-date returns for 2023 are 33% so far, and cash on hand is over $167 billion. That makes up over 6.3% of the entire S&P 500's cash on hand. That's nuts. With yields on short-term bonds paying around 5 to 5.5%, that equates to $9 billion in interest payments alone that can be thrown into continued R&D or acquisitions on behalf of the company. Yes, Apple is falling out of vogue primarily because people get bored too quickly. But here's some facts. You spend about 24.5 hours a week staring at your phone. That's 3.5 hours a day, 7 days a week on average. Wow. And that number is just increasing. So are you willing to throw in the towel on Apple? Not me. Now, my favorite of the 7 is NVIDIA, with a year-to-date return of over 200% so far, and no sign of letting up. Though I'm not crazy about the valuation trading at 100 times earnings, I am sold on the fact that they too have over $16 billion on cash and are buying back $25 billion of their own stock, even at today's prices. Now, volatility is the key word here, as the price tends to fluctuate widely. But that again sets up great opportunities to cover your positions using options to protect and to hedge. My next one on the list is Google. Okay, this one's pretty boring. Only a 50% return on your investment since January 1st this year. Now, I know you're looking for better. A low price to earnings of 28 and cash on hand of $118 billion doesn't get, I guess, you too excited. Well, you're not too bright if that's the case. Now let's see, you're watching this video on YouTube, the second most watched website in the world. Oh, and who owns YouTube? Google. Oh, I forgot, the #1 visited website in the world is Google. Next up is Meta. Yes, the 3rd most visited website, and Lord knows they're predicting up to $12 billion of spending on political ads in 2024. This will keep you glued on that phone to get all worked up each day, screaming at your favorite political ad. Now, with a modest year-to-date return of 150% and $54 billion cash on hand, they're barely getting by, it seems like. In addition, commitment to spend $33 billion on AI to help those of you that have that dreaded disease called selfitis. Now, the new word coined for taking these selfies by Sebastian Maniscalco is taking a lonely. That better defines it, for me at least. Hey, whatever floats your boat, you keep taking these lonelies and posting, and I'll keep acquiring the stock. Now, my wife's favorite on the list of 7 is Amazon. Well, why not? Our Dunkin' Donuts coffee, paper towels, toilet paper, contact lenses, toothpaste, shaving cream, and not even to get into clothing and the countless accessories, you name it, and we've bought it scenario. I just pulled up, we have ordered over 193 items in 2023 so far and have 3 months to go for the year. Again, Amazon stock is only up 50% this year, and they have $64 billion in cash on hand. Disappointing, isn't it? Next up is Tesla, up 99% for 2023. But over the last 12 months, they're down about 5.67% off their highs. But I've never owned Tesla, but I've been trying to buy the stock for over a year now. Am I excited about electric cars? Heck no. And the funny thing is, either is Elon Musk. I want to own a piece of Elon, not electric cars. And at today's price, it's a bargain. Remember, it's still trading at about almost 40% off its all-time high of around $407. With 23 billion cash on hand, nobody can stretch a dollar like Elon and into places you and I haven't even thought of. Between SpaceX, Tesla, X or Twitter, XAI, Neuralink, and the Boring Company, you want a piece of him, and I like his attitude of go pound salt. Again, a great place to acquire income while waiting to purchase his shares at a discount by selling options. Now, unfortunately, most firms or advisors are too cookie cutter and lazy to even consider the alternative. Again, and more probable, they don't want to work or to even actually collect their fees. But Elon is a great buy long term. Last on the list is Microsoft. Now, this one I don't own it and probably won't, but it's up almost 31% for the year so far. So I've left some money on the table here. You can't win them all. When you already own 85% market share worldwide, it's hard to imagine where else to go as a company. But $112 billion in cash at Microsoft gives you options to go places that others can't imagine. So if you want an IBM or Coca-Cola of days past, you can't mess up here at all for the unforeseeable future. These 7 mega companies are today's staples. Now, most firms own a fraction of these companies in mutual funds, but that's exactly the problem. You get a fraction of the returns of these companies. Let's take, for example, the NASDAQ 100 so far this year is up 33%. Not bad. But if you take these 7 companies off the list, you would only have 6% return in the index. These 7 companies now sit at a 77% return year to date on average across the top 7. We're in an unusual situation, but skyrocketing bond yields are bad news for the vast bulk of the market. Now, the mega cap companies are the big exception to this rule. You want to make it through this difficult time, then this is where you need to be. Even Jim Cramer, who I'm not a big fan of, says few companies have the balance sheets and product demand to withstand the bond market competition. The so-called Magnificent Seven that I just mentioned, stocks, aren't hurting for money and are actually coining a future with their considerable cash hoards. Now, it's funny, we used to look at their gigantic cash positions and their cash management attempts to try to bring in a little extra income is just kind of a waste of time, an abstraction when interest rates were low. But now they're huge winners, and I think you'll begin to see a line item in their quarters, the money they make off their cash, that could finally offset some of the miserable losses from the darn strong dollar. As with all our choices, we cover our backside when owning these companies, utilizing options to protect against fast-moving conditions. But patience is the key, and rising rates is not a great environment for 99% of the companies out there. But with hordes of cash on hand like these great companies, you get great yields. These companies will weather the storm through an economic tough time. If your advisor or firm is just shoving your money in mutual funds and not owning these companies individually, then you need to run. Better yet, give us a call. Now, let me say this. If you've enjoyed this video, click subscribe below and hit the thumbs up. And for goodness sake, go look at our website where we've posted countless videos specifically why these specific companies were where you needed to be 10 months ago. Till next time.